All right, we have another great speaker coming up. The company is called Applied Analysis. And whether you're a state agency, the governor, or you're a business and you want the best financial advice and information, Applied Analysis is the company you go to. And Brian Gordon is a principal with Applied Analysis, and he's going to talk to us today in part about halting residential permits in Douglas County, a very light topic.
So I've got a slew of presentation slides that I'm going to run through, hopefully in relatively quick order, give you some highlights of the work that we've conducted, and then I think we have an opportunity for questions and answers towards the end of my presentation. The request was pretty simple. The Business Council of Douglas County asked, can you quantify what the economic and fiscal impacts are of halting residential development activity in Douglas County? And so this is the process that we've gone through. This is a summary of the analysis that we've conducted. These are the main components of the analysis that we prepared. Specifically, I think it's important to talk about the growth management ordinance that's in place today in Douglas County. We'll also talk about some of the trends that have evolved over time, look at how the shift in the housing market has unfolded as of late, and then really get into the nuts and bolts of what those economic and fiscal impacts are under a scenario where residential development activity is essentially halted within Douglas County itself. So the growth ordinance, the Douglas County Master Plan cites that the intent of the ordinance itself is to preserve and enhance the quality of life for the communities and inhabitants of Douglas County. To this point, it seems like it's been working relatively effectively and that there are some positives sourced to that overall ordinance, and it's doing what it was intended to do, potentially limiting or restricting the amount of growth that takes place. I'm going to walk you through the key elements of the growth management ordinance just so you have a feel for what that process looks like. For many of you, you may have seen this at city council meetings, or commission meetings rather. This is really to give you the foundation or the background of how things have evolved in Douglas County specifically. The ordinance itself was passed in that 2007-2008 time frame, and what that did is it created a sort of base amount of permit allocations that are likely to be developed in Douglas County. That resulted in about 317 annual permits as of 2017. The math was pretty simple. They took how much population growth was expected in that particular year, divided it by 2.5 people per household, and you resulted with about 317 new residential permits in that year. And then that was allowed to grow at about 2% annually. And this is what that trend line looks like. Over the next 50 years of the growth management ordinance, we're talking about a total of almost 27,000 housing units from 2007 through 2056. And so you can see that trend line and what that looks like over time. There's a little bit of a nuance to that. At the outset, there were a number of projects that were already in the development pipeline that had development agreements in place, if you will. And so we took a look at what those look like, and the county looked at these 4,700 plus units that were already in the process and called those the vested projects, allocated those out over approximately a 25-year time horizon to adjust the annual allocations that are ultimately available to the rest of the development community. So you can see here on the chart what that looks like when you spread those vested projects over the next 25 years, and you can see what the remaining allocations are as a result of that. So we knocked out those 4,700, and you see the remaining allocations as of that point in time. The next step in the growth management ordinance process was really to look at the balance of those allocations. And those allocations get split between two different buckets. Some are individual units that have the potential to be developed. The other portion are really these projects, if you will, that would be developed into the future. And you can kind of see the breakout there, 70-30 split. And really what the individual projects mean, these are individual, less than 4 lot types of developments. So these would be your typical custom home types of developments. The project-related developments are really your 5 and over unit types of projects, your more traditional developer subdivisions and communities that would be developed. So we're seeing 30% in the project-related allocations and about 70% in those individual or more custom-style home development allocations, permit allocations. So then we split those further so you can see the trend lines among those unvested projects, if you will, about 22,000 units overall, and the split between individual projects as well as the major projects, larger projects that have the potential to be developed. These are the allocations in advance of pulling an actual building permit. These are the allocations by year. And then each year, if those allocations aren't used, they then go into this pool that can ultimately be used in the future, so you see a little bit of a cycling there. And this is where we're at today. On the individual permit allocations, we've got about 1,400 to 1,500 permits that have, or allocations, I should say, that have gone unused to this point, and you've got about 584 in the project category that have gone unused as of today. What we noticed is in the last 3 years, you've got about 37% of those individual allocations being used. However, on the project side, we've used almost all of those allocations to date in the last 3 years, which tells you that the larger projects are really experiencing more of the demand relative to the number of allocations that are available. And there's still a number of the individual allocations that remain today. What happens is that goes back in the pool. The number of allocations in the following year increases by 2% as outlined in the Growth Management Ordinance. A little bit of a history lesson, a little bit of an education. I apologize for having to walk through that level of detail, but I think it's important when we talk about the next steps in terms of where Douglas County is headed. So the general county trends that we've seen here, I guess the question that becomes next is, really what has emerged in Douglas County as a result of the overall ordinance. This gives you a sense of some of the impacts that we've been looking at. The population in Douglas County has certainly been changing. There's no question about that in terms of what's happened as of late. I'm going to walk you through some of the detailed data, maybe more than you want to know, but I think it's important that we do get our handle around exactly what has emerged in terms of population trends. So this is one set of data, the most recent from the demographer. This is the Nevada Demographers Governors Certified Series through 2020. You see we have about 49,000 people that live in Douglas County. You can see the trend lines, the substantial growth that took place, sort of peaking out of over 52,000 folks in that 2007-2008 timeframe. We saw some softening and really more stabilization in terms of the overall population trends in Southern Nevada. This is just one data point. We've talked with staff at Douglas County and obviously analyzed their master plan to get a feel for how they're looking at information. Another series that they've reported on at Douglas County has a little bit more of a smooth trend line in terms of the trends of overall population growth in Douglas County. Regardless of the data set that you're looking at, you're seeing that flatlining or stabilizing trend as of late within the last several years in Douglas County. Annual growth rates. You can see what that looks like in terms of the annual year-over-year trends in terms of population growth. The average, the long-run average, is really at about 4.1%. And if we look at what's been happening since the implementation of the growth ordinance, we've seen population growth trend negative by about 0.5% on average per year. And so you kind of see that there's been a shift sort of pre-ordinance to where we're at today. And again, if we look at the population forecasts within Douglas County specifically, you can start to see the tailing off of the expectations of where overall population is likely to trend on a go-forward basis, with population diminishing to about 45,000 people by the year 2039. That's the outlook, the 20-year time horizon in terms of overall population growth. So what does that look like? Population is expected to contract by an average of about 0.4% on a go-forward basis. And if we look at where we were about a decade ago in terms of relative to the current forecast, the latest forecast post-implementation of the Growth Management Ordinance, we expected to continue to see some growth, positive trends overall in terms of population, going from about 49,000 people up to about 54,000 people. In 2010, we saw what happened in terms of actual population growth and then what the new forecasts are. We now see more trailing off in terms of what the new expectation is for population growth. So again, there's been a shift there, a loss of a potentially 5,600 to 5,700 residents in Douglas County between the forecast just 10 years ago and today. So there's clearly been a shift in terms of the dynamics that are taking place in Douglas County. Overall, the expectation going forward through 2039 is that population will decline by about 7.5% overall, a sharp contrast to what we've seen statewide in Nevada as well as across the United States. We're seeing nationally the population forecast is going to be about 8.4%, and in the state of Nevada, it's about 11.3%. Nevada has been and will continue to be one of the fastest growing states in the country. That's a sharp contrast to what the expectation is here in Douglas County. What else are we seeing? The community demographics overall are also changing in Douglas County. I don't think this comes as any surprise to anybody. If you take a look on the screen here, you can see by age demographic, how has population trended historically, just over the last decade. You see various age categories, what that looks like in terms of overall population. But if I show you what the older segment of the population looks like, the overall population is continuing to age. You see that folks that are 60 plus years of age or older trended from about 29% of overall population to almost 40% of the population in Douglas County. No question about it, the population is aging here in this area. The median age just a decade ago was nearly 47 years of age in Douglas County, and where do we stand today? It's about 52 years. That's the median overall throughout the county. We've seen, obviously, the age demographics are shifting, and if we compare that to what the state as a whole looks like, or we compare it to what the United States overall looks like, there's clearly a disconnect. It's a different type of community, it's a different demographic, and the development activity within Douglas County is also responding a little bit differently. We look at things like K through 12 education. The Douglas County School District has continued to see their enrollment erode. We've seen it trend down by about 19% since 2004, and you can kind of see and get a feel for what's happening specifically here in this community. And this is a real key point that I want to make here as part of the demographic analysis, if you will. When the growth management ordinance was developed in 2007, it was predicated on the idea that there were 2.5 people per household. That has changed over time. We have continued to see household sizes shrink, contract, and have fewer people in them. As the population continues to age, younger folks are moving out. We are continuing to see smaller household sizes. Through 2019, the latest available data through the U.S. Census Bureau tells us that there's about 2.31 people per household, much different than it was not that long ago, and we are expecting to continue to see those trends continue. Why is this important? This impacts the overall demand for housing. Household sizes in Douglas County average of 2.31 persons per household, and we look at what it's like in other portions of the state or the nation as a whole. Again, much different demographic dynamics taking place here. And so what has that done? That's had an impact on what we're seeing in the housing market. That has created a shift in terms of demand for overall housing units, maybe different than you would expect when we are talking about stabilizing, flatlining, and potentially declining population. That may not be the trends that ultimately emerge in terms of demand for housing units. This is the historical trend line in terms of the number of housing units. Over the last 20 years, you can see we have almost 25,000 housing units here in Douglas County, and what the trend has been. Historically, the growth has averaged about 1.3% on the housing unit side and about 0.7% in terms of population. But what's happened since the implementation of the growth ordinance? Obviously, the Great Recession plays into that. I think that's worth mentioning. But you see that population growth has been contracting or flatlining, depending on which numbers you look at. But the reality is that housing unit demand has continued to press forward to the tune of about 0.5% per year since 2007. This has really created a shift in the housing market that I think is worth pointing out. And if we look at historically where we've been in terms of the number of residential permits, you can see the ups, the downs, and the recovery and the continued development activity that is taking place today. Permits in 2021 have continued to expand, increase, and we're continuing to see that development activity continue. But what I want to do here is layer in the concept of the growth management ordinance that I walked you through before. This demonstrates the maximum amount of units or the permit allocations that would be eligible in each one of these years on a go-forward basis. So the green sort of area you're seeing assumes that the community were to build out at its maximum level allowed each year under the growth management ordinance. We've also put in a couple of more conservative scenarios. What happens if we develop out at 75% of the maximum under the growth management ordinance? What does it look like if it's at 50%, 25%? I think you can kind of see where those trend lines are heading today relative to where we've been. Would it not be unreasonable to see it in the 50 or 75% range, maybe more? But at the end of the day, the maximum by 2040 still is in line or below prior peak levels. So this tells you this is a relatively conservative pace of overall development activity on a go-forward basis. We add all those numbers up, and what does it tell us? If we were to halt residential development activity in Douglas County, and we were at the maximum, we had the potential to develop at the maximum amount under the growth management ordinance, we'd lose potentially 10,000 units over the next 20 years. It's about 500 units per year that would vanish, that would have been developed otherwise, in the event that residential permitting activity were to be halted. Under the other scenarios, you can see what that looks like. 75% threshold, we're talking about 7,600 units vanish over that 20-year time horizon, so forth and so on. You get the idea. Big numbers in terms of the number of housing units that potentially go away should there be a shift in the policy that exists today. The next element I want to walk you through the job impacts associated with halting residential development activity. This is really the key economic component of the equation. What you're looking at on your slide today demonstrates exactly the employment structure of Douglas County as it exists. We've got almost 16,000 people working here in Douglas County, and you can see the breakouts by industry. I just want to highlight for you quickly the construction industry. We're talking about over 1,500 construction-related jobs that exist in Douglas County today. That's almost 10% of all the jobs in the community, a pretty critical component of the overall job base. I also want to walk through standard sort of economic modeling and what we did. I'll give you a couple of different definitions here. The types of economic impacts that we looked at. Economic output, this is a very standard measure of economic activity, the amount of spending that takes place in the community. We also look at wages and salaries. How much do people earn? How much do workers earn in the local economy? And then from a job standpoint, how many people are we talking about employed in the local community? We also look at the ripple effect of that economic activity. So think about the direct impacts that take place. If you were to extract residential construction out of the equation, people would lose their jobs. We can quantify what that looks like. So those are the direct impacts of a potential sort of shift in policy, if you want to think about it that way. There's also the ripple effect, the indirect impacts. Vendors that supply materials and goods for residential construction companies. They buy lumber. You heard about how that's flowing through the economy and some of the volatility that's taking place there earlier today in this conference. But you're talking about jobs that support that industry, vendor purchases. You also have induced impacts. These are really the spending impacts. So a construction worker takes their paycheck home, they go to the grocery store, they go to a doctor's office. We can quantify how much activity that means throughout the economy. We take all that together, we get our total impacts. Again, a little bit of an education. You guys probably understand this as well as anyone, but I'm going to walk you through the data, so I wanted to just provide you that overview in terms of what we're looking at from an economic standpoint. Direct impacts. So I mentioned the 1,500 jobs in the construction industry. I'm not here to tell you they're all going to go away tomorrow if we were to halt residential construction permits. Certainly that's a possibility, but about 42.5% of all the construction jobs in Douglas County are specifically dedicated to new home construction, single-family home construction, multifamily home construction. We add those jobs together, it's about 650 jobs. You see the indirect impacts, the induced impacts. Overall, we're talking about 911 jobs potentially gone as a result of halting residential permitting activity and related development activity in Douglas County. And if we look at over the next 20 years, you know, construction jobs tend to be temporary in nature. If they have another job to go to, they work the next job, so forth and so on. So at 900 jobs per year over a 20-year time horizon, you're talking about 18,000 person years of employment. That's a very common sort of economic analysis term, but that's what that looks like over a 20-year time horizon. We also wanted to look at the wage impacts. You see the direct, indirect, and induced impacts. The point I want to make here is you're talking about approximately $62 million in annual wages being extracted out of the economy over a 20-year time horizon. You see the numbers, $1.2 billion potentially lost should residential development activity go away. And from an economic output standpoint, again, these are big numbers. $125 million annually is supported by residential construction activity, new home development specifically. And if you look at that over a 20-year time horizon, you're talking about $2.5 billion of lost economic activity over the next 2 decades. The next piece that I think is really important, particularly for local government in Douglas County, are the fiscal impacts, the public revenue impacts of halting residential development activity and what that looks like. I'm going to walk you through the few pieces and parts of what we analyzed as part of this study. Sales tax tends to be a recurring impact overall in terms of consumer spending. Again, you get the idea. You have a sales tax rate in Douglas County, 7.1%. Every dollar that goes into that is dedicated or split among various taxing entities. Some goes to the state, some goes to local school support tax up at the state and gets filtered around. You have some local beneficiaries of that tax. You're talking about 2/3 going up to the state and about 1/3, 35%, if you will, that stays down in the local area. We've quantified that, and I want to show you what the impacts of that are. Within that other category of miscellaneous facilities and services, those dollars help support things like libraries, senior services, parks, recreation, other infrastructure. So those are some of the key beneficiaries of those dollars. Local sales and use tax per housing unit today in Douglas County, each household generates about $2,500 of sales and use tax on average. You take all the taxable retail sales, you take the number of housing units, you do the math, it's about $2,500 per housing unit. What does that look like under those different thresholds that I walked you through under the Growth Management Ordinance? If we were to halt all the residential development activity and assume that we would have built out at that annual allocation level, you're talking about almost $13 million per year. You see the numbers in terms of the other impacts at the various thresholds. And then what does that mean over the next 20 years? You're talking about $250 million potentially lost as it relates to sales and use tax should residential development be halted, and we could have developed at the maximum allowed under the Growth Management Ordinance. We then break those sales taxes down into those various components, parts that you see here on the screen. From left to right, you get the idea of what they are. One important distinction here in Douglas County is that it's a guarantee county, so the the supplemental city-county relief tax, again, that portion of it, this is really for your local government folks. We've sort of knocked that out given your guarantee county status, but you get an idea of what this potentially looks like from a state standpoint, from a local standpoint. $26.5 million overall during that time horizon potentially vanishes as a result of a shift in policy. Another recurring revenue stream is really property tax revenues that you can imagine is pretty important. You've heard about how that's evolved as of late. But again, every dollar of property tax, the segmentation of that information, you see what goes to the state, what stays locally. We're talking about 64% of every dollar really stays local, and you see the various taxing entities that are beneficiaries of property taxes overall. On average, every housing unit generates about $2,821 of property taxes. Take the total property tax revenue divided by the number of housing units, you get the idea. Similar math that I walked you through on the sales tax side. What does that mean under each one of these scenarios? Again, Similar numbers on an annual recurring basis, $14 million in lost property taxes, potentially $282 million over the 20-year time horizon, and the various potential scenarios that could have unfolded. We have state components, we have local components. Again, you see the breakdown here. I don't need to dwell on them, but you're talking about nearly $200 million in terms of lost revenue at the local level. That has the potential to be problematic. We also looked at a number of non-recurring revenues. So you heard the comment earlier today at this conference, growth sort of pays for growth. Nevada's fiscal structure is generally designed such that growth continues to make the investments that are necessary for continued growth. This is where some of these non-recurring revenue impacts can be pretty material. I want to walk you through these pretty briefly. We're talking about the residential construction tax, what it looks like per housing unit, schools, parks, transportation, plan check fees for the East Fork Fire Protection District, how much those annual fees look like. We also have permits and allocations, all these other fees that go into residential development activity. You can see what they look like. You have water connection fees of $3,100. You have sewer connection fees averaging about $2,300. And so you put all of these non-recurring revenues together, and what does that look like? You're talking about $18,000 for every new house that comes online. These are the fees, charges, permits, costs that they're paying to bring that new housing unit online. If we are not bringing new housing units online, you get a sense of what the fiscal impact is for the community. We're talking about $9 million a year at the maximum allocation level that we were looking at. Even at a lower threshold, you get the idea of how much money that means. And over the next 20 years, we call these non-recurring revenues, but year in and year out, if you're building homes, these essentially become recurring revenue streams that all of these agencies that I just mentioned tend to rely on to support the development and infrastructure taking place in Douglas County. The combined impacts, we put non-recurring and recurring revenues together, you get the idea. The point here is that there's potentially a loss of $20 million in annual revenues sourced to local agencies, including Douglas County. We've stripped out anything that goes to the state. These would be local revenues that we've focused on here. And over the 20-year time horizon, talking about potentially over $400 million in both recurring and non-recurring revenues over the next 20 years. I also want to point out that if those dollars are ultimately needed, and I'm not here to suggest that every one of them would be required, but if we looked at that total potential loss in local revenues, and we looked at how many housing units exist today, the 25,000 or so houses that are here today, that's an increased potential tax burden for every homeowner in Southern Nevada of about $16,000 over that study period. Pretty significant. And when we look at that at the various thresholds, it still remains a material number. At the 75% scenario, let's imagine we developed out at 75% of the maximum permit allocations under today's growth ordinance. It's about $15 million a year. And over the 20-year time horizon, we're still talking about a $300 million number, pretty substantial. And if we look at what that burden looks like on every housing unit that exists today, if those revenues were to go away, again, pretty significant numbers. I'm going to wrap this up with just one final slide and tell you, the summary implications of all of this and what does that mean. I've talked about the economic impacts. We're talking about 651 jobs directly in new home construction, over 900 jobs when you consider the ripple effect or the overall results of extracting out new residential construction. That has a pretty significant effect. It also doesn't really quantify what the other spending impacts would be. What does that do in terms of additional investment into the community? Do other investments stop taking place because the housing market is not growing and we're seeing fewer, potentially no residential development activity? The business investment implications are pretty significant. Fiscal, again, I've walked you through all of the entities that are potentially impacted by a scenario where we halt residential development activity. And then there's a number of social impacts that I haven't walked you through, but think about housing affordability. You've heard a lot about that already today. The lack of development of housing only has the potential to put upward pressure on prices. We're seeing that everywhere across the country, including the state of Nevada, but it will become increasingly problematic here in Douglas County. Commute times will be longer. What does that do to roadways and the health and wealth of roadways? You know, that has the potential to be impactful as well. Just general quality of life factors that could be impacted by a shift in policy. I did want to just say a quick thank you to Renee, the team here that's put today's conference on, the board of directors of the Business Council of Douglas County. Aaron West at the Nevada Builders Association has been very helpful during this process, helping in collecting some of this information. And then staff at Douglas County has also been critical as part of the team in terms of providing information when we requested it. Tom DeLaire, Sam Booth, I really appreciate all your time and effort and assistance in allowing us to access information that allows us to do our work. So I wanted to say thank you. I understand we may have some questions, so I'm happy to answer them.
And I'm right here.
You snuck up on me.
Yes.
Thank you.
Thank you very much, Brian. So basically, we should get people to buy crutches because a lot of people may be shooting themselves in the foot if this all goes through.
Yeah, I mean, it has the potential to be very problematic. The growth ordinance has restructured how residential development activity can ultimately unfold, and that puts some restrictions in place. Those restrictions appear to be working. But should an alternative scenario unfold where we simply eliminate all of the residential development activity, I mean, that has the potential to have real implications both in the economy but as well at the state and local level from a fiscal perspective.
There are some that think that there is a lack of water, but according to the numbers, that really doesn't appear to be true.
Well, look, water is certainly a hot button issue. The drought has sparked and renewed those discussions. The state of Nevada is doing a lot of things to cure and curb water consumption. New residential homes tend to be some of the most efficient users of water relative to resale homes, ag uses, other uses that take place, and so they're relatively efficient users of that. You know, so how that ultimately unfolds, I don't know, but clearly this could be a shift in terms of how local governments function.
Yeah, I mean, according to the information I've seen, we're not close to utilizing the amount of water that would be problematic. And so I just want to throw that in there. One other thing I just wanted to throw in was right now, Douglas County is a receiver county, meaning that they get income from 4 other counties, but that could change. What would be the potential effect of that?
Yeah, I mean, anytime you're talking about shifting how the fiscal structure is designed, that could be problematic. You know, I mentioned, you know, some of those revenues are guaranteed from the state. This sort of concept that you're talking about certainly has the potential to create a shift. But like I said, the growth model that most counties have been designed for, when you change the policy, that can result in a much different dynamic and create fiscal constraints at the local level.
You know, basically, I mean, to me, as a businessman, if you're not growing, you're going backwards. Even if you're staying the same, you're going backwards. Am I right in that?
I think that's how most business owners would look at the world, right? That they're in business to succeed, and a lot of times that success is predicated on its ability to continue to grow. So yes, I think that is the mindset and the right way to think about it. And I think, and I hate to be repetitive, but that's a lot of how the fiscal structure, not just in Douglas County, every county in the state of Nevada and the state as a whole, that is how they are designed. Those revenues that are generated as a result of the growth is what helps feed a lot of the infrastructure that we need and we see today.
Renee, you have a couple of questions.
Hey there, Brian. Fantastic job. Thank you so much. In your firm's line of work, your expertise is studying data, analyzing it, and putting it in a framework that a layman could understand, and then it gets more comprehensive and upgraded from there. So I'm not to say you're dumbing anything down, you're not. But it's very complicated information, and you've made it palatable to every constituent in this district, they can understand that you cannot suppose or suggest, if you have no new taxpayers and you have no new taxes, it doesn't work.
It's problematic.
It's problematic. It's a problem. I'll just say it.
You did.
It's a problem.
And I don't know that I can argue with you.
The other thing is, when you took these thousands of pieces of data collected from all accredited sources, as you do in your line of business, this doesn't suggest at all that we go over 2%. You've shown clearly that we're not even a half of what the voters said would be okay. You're not even close to that, and that's driven by economics, not by an ordinance. But the voters said, we're okay with this or below, and that will work. But at some point, there's no suggestion that you're saying, we need to go to 5 or 6 to live and exist. That's not what you're saying. You're saying, if we maintain what we're doing now, which is well under 2%, then most likely the budgets can be balanced as they are, and the predictable budgeting cycle on dependable data can happen. But if it were to stop, then chaos kind of ensues.
Yeah, I think that's all generally fair. Look, we didn't do a comprehensive top-to-bottom analysis
Right.
of Douglas County's, fiscal structure, but we do look at these public revenues and how that could shift dramatically. I think the other thing you're sort of alluding to a little bit is, we've designed the growth management ordinance has been designed with a 2% annual growth rate.
Right.
There's some nuance within that too,
Right.
and part of the reason I'm assuming we haven't seen some of those maximum thresholds reached at different points in time, the formula or the mechanics are also a little bit differently in the fact that, I mentioned 70% of those allocations are for individual projects, really your single custom lot types of developments. And 30% are in that attached or larger, sort of more traditional developments. That 30% of a smaller number after the vested projects, you're talking about 25% of the annual allocations effectively are eligible for more traditional subdivision or community types of development. So that's also, putting a little bit of a governor, if you will, on the amount of development that can actually take place. So that's a little bit of a nuance within the ordinance that I think is also having putting a bit of a limitation on the overall development that's ultimately unfolded.
Well said. It's a complicated subject. The Business Council membership meets every month, and this is a large discussion that's gone on since, early 2000s, and we have the voters approved the plan, and there's always been discussion. Is it working? What happens if? And so on and so forth. So we thought it was time to answer the questions and respond to what happens if in these certain scenarios. So your accredited firm did a fantastic job, but the discussion's not over. It's just beginning in terms of, now that it's all put together, let's start talking about that. And let's start talking about the data, the actual live data of what actually happened versus what they thought would happen. And your lines went down and not up. And San made some great points about how you exist as a community and sustain. So we're going to have you back.
Okay.
Hopefully at some general membership meetings, and we meet here at Carson Valley Inn, but we haven't been able to. We've been meeting online, and they're all still there online with us. So with that, I want to thank you so much, and you're part of the team. We appreciate it, and we're going to make sure that we continue the conversation with you. Thank you.
Great. Thank you.
All right.
Appreciate
Thank you
the
so
opportunity.
much.
Thank you. Thank you, everybody.